You may remember Carvana, the online car retailer that almost declared bankruptcy a year ago. That same company has since experienced an astronomical surge in its stock price over the past 12 months, booking a staggering 205% increase. This massive rally might make you think that this company is unstoppable, but there's more to the story than what meets the eye. Even with its current rally, Carvana stock is still down by nearly 90% from its peak. In fact, if you take a look at the stock's performance over the past 5 years, you'd see that Carvana stock peaked at $380 in 2021, but then fell by a jaw-dropping 99% to $3.63 by the end of 2022. So what's the deal with Carvana? What caused this dramatic decline, and how is the company staging its comeback? In this video, we'll answer these questions by comparing Carvana's highs and lows so you can decide if this stock is now worth investing in. Let's dive right in. Welcome back to PST Markets. During the pandemic, when interest rates were near zero and everyone enjoyed stimulus checks, Carvana was a promising auto startup and a Wall Street darling that completely transformed the car market. At its peak, it had a market cap of nearly $70 billion, which is around the same as legacy automakers like Volkswagen and BMW. The best thing about this was that Carvana wasn't even an automaker. The company, founded in 2012, was essentially a used car dealership that made it easy to buy and sell cars online from the comfort of your home. Then the cars were picked up from one of Carvana's revolutionary car vending machines, which were spread across the country, all without having to deal with a single car salesperson. A big part of Carvana's business depended on the company financing people with low credit scores. So they bought the cars on the platform, which allowed Carvana to make a lot of money collecting interest. However, Carvana saw a massive fall from grace when the Federal Reserve increased interest rates in 2022 because its customers' borrowing costs increased and demand for its services decreased rapidly. This greatly hurt the company, which made billions in revenues but was actually never profitable, despite selling their cars at a really high markup. You see, buying, selling, and shipping cars across the country was a very expensive process, and the company incurred massive costs. In fact, even during Carvana's pandemic-fueled boom, it recorded a loss of $1.6 billion, which investors didn't mind so much since the company's revenues in car sales were skyrocketing. However, the sentiment around the stock changed when it started declining. While all this was happening to Carvana, the stock market took heavy hits thanks to the harsh macroeconomic environment, such as the high interest rates and high inflation. So it's no surprise that a company with bad fundamentals like Carvana was hit harder and threatened with bankruptcy. This leads us to where Carvana is today, when the company recently posted its first ever real profit of $782 million, which has been enough for a lot of investors to buy back in, fueling the current run for Carvana stock. But how did the company manage to turn its fortunes around like this? The answer to this question is an aggressive cost-cutting strategy. The company cut headcounts by more than 4,000 people. It launched a new software platform called Carly to support its vehicle reconditioning operations by recording the vehicle's inspection in a step-by-step process that included price checks, benchmarking costs for parts, and overall expenses per vehicle. It also implemented a pricing and sales system powered by AI, eliminating the need to input data into separate systems or spreadsheets manually. Carvana also completed a debt restructuring deal with the majority of its creditors, slashing about $1.3 billion of debt and saving the company more than $455 million of interest expense annually over the next 2 years. These were crucial moves for the company and have proved themselves to be successful at saving the company from bankruptcy. At the end of Q3 of 2023, Carvana had $544 million cash and cash equivalents, an increase of $228 million from the end of 2022. The company also reported total liquidity, including additional secured debt capacity and other factors, of $3.18 billion. It also cut selling, general, and administrative expenses by more than $400 per unit sold compared to the previous quarter, which resulted in a record third-quarter gross profit per unit sold of $5,952. Carvana is currently in the middle of Step 2 of a 3-step restructuring process that the CEO, Ernest Garcia III, initially laid out to investors roughly a year ago. Step 1 is dragging the business to break even, and Step 2 is dragging the business to positive free cash flow. Step 3 is returning to growth. Garcia said that taking the company private was never an option, which came off as a relief to investors. He also added that the company is largely done with taking fixed costs out of its business, and that he believes that there's more room for reductions in variable costs to increase profits even more before returning to a growth-focused company again. It's important to note that the company made this possible by hiring experts with different backgrounds, including people who worked at auto powerhouses like CarMax, Ford, and Nissan. So Carvana's main play here is cutting costs, but is this sustainable? Or is it just enough to save the company from bankruptcy and not do anything else when it comes to growth? According to JP Morgan analyst Rajat Gupta, the company is going down the correct path, and this strategy could give it room to improve its cost structure further. Still, the company needs to drive additional operational efficiencies to maintain this success. He thinks these efficiencies would come from further developing internal software and standardized processes by implementing AI technologies, as well as improved training and career pathing of potential new hires after the massive layoff. This could mean that the company will maintain profitability in the next quarter at a level similar to what it's currently experiencing. Of course, we'll know for sure once Carvana's earnings are released on February 22nd. With all of this in mind, is Carvana stock a good investment? Many investors are back on the Carvana bandwagon after the company managed through the last 2 years, but some concerns remain. The biggest of all is the company's debt, which increased even more thanks to its $2.2 billion acquisition of Edisa, a used car auction business that Carvana bought when it was struggling to keep up with the soaring demand during the pandemic and looking for different growth engines. As we talked about earlier, Carvana managed to reduce its total debt outstanding by more than $1.2 billion through a restructuring deal. But this was like a double-edged weapon for the company, as it also kicked much of the debt to later this decade, at largely higher interest rates. The old notes, which carry interest rates ranging from just under 5% to more than 10%, are due between 2025 and 2030, and the new ones are expected to mature in 2028. The old and new notes make up roughly 78% of Carvana's nearly $6 billion total debt. Wholesale used car prices fell by 7% year-over-year in 2023, and if this trend continues, customers will choose to buy cars from dealerships rather than Carvana's platform, which sells the cars at a significantly high markup. This could mean that Carvana will have to start competing on price to draw customers away from traditional dealers, which may threaten its recent gains. In addition, the company's largest share at 24.68% is owned by Ernest Garcia, the second, the billionaire behind DriveTime, and the father of Carvana's CEO, Ernest Garcia III, is considered problematic by investors. Even though having DriveTime's backing helped Carvana become successful, since it's also a company that deals with used cars, the connection between the two companies has brought several lawsuits against the father-son duo in recent years, largely involving the family's businesses. In fact, the company was actually sued by 2 large North American pension funds that invested in the company but then said that the Garcias ran a pump-and-dump scheme to enrich themselves. So, the road ahead is still not clear for Carvana, and we think that this sharp surge in the stock, despite the bad fundamentals, makes it more than appropriate to exercise some caution before making any investment decision regarding Carvana stock. For now, it might be wise to remain on the sidelines until we see more clarity on the fundamentals. Well, that is everything for now. What do you think? Is Carvana stock a good investment right now? Please let us know in the comments below. If you haven't, please subscribe and like this video. Your support helps us continue our work. Thanks again for your support, and I will see you in the next one.